and welcome to the show, if you can call it that.
Yes,
Just
the morning
as
show.
so, just as an introduction, I mean, I'm going to Japan's introduction would probably last half an hour, so I'm going to keep it a little bit shorter than that. Many of us at Capital Mind Premium know him as this phenomenal investor, but his qualifications are also quite phenomenal. He is a managing partner at
Six Sense Ventures.
Which is a venture company and venture capital company. His past he was with
IDFC IA.
and he as the director of investments, he was able to raise two funds. One just after the crisis of 2008, in fact in early 2009, two funds which scaled up to an AUM of 850 crores over 4 years. One of the few funds that will actually return money to investors after having invested in the infra space. He's also had phenomenal experience in companies that you now know as almost household names like 197, Ratnakar Bank, IndusInd Bank, NSC, Trent, and VA Tech Vabag. And also, of course, he has his own investments, which we know about in Capital Mind Premium, about some of the awesome companies that have been discovered and nurtured, perhaps, and now are on the path to getting bigger. So, welcome, Japan. I hope I didn't under-introduce you in the process.
This was an embarrassing, really long introduction. Thank you very much.
So let's get straight on. I think what we'll do is, on Slack, a bunch of people are looking forward to asking questions as well. But we also have, I'm just going to structure it as as a informal question and answer session. One of the investments that we've seen, and I think that's one of the things that have been triggering a thought process a lot, is a stock that has moved substantially. Sunil Healthcare, one of India's largest capsule gelatin or capsule manufacturers. What prompted you to think of that as a stock, or what prompted you to get in?
So the right answer would be to say that I identified it and I was hunting for it. But that was not the case. Typically, most of the transactions come our way is either through a reference or somebody speaks about it, and then you do more work on it. So this was actually the name was introduced by a friend who said there is a seller in this. Would you want to do work on it? And when I looked it up the website, the first thing was this was the second largest capsule manufacturer. Capsule shell manufacturer in the company. Fundamental thing is in India, anything and everything could have a large market. We are so big that any product, any service could have a reasonably large market. So if there is somebody who is the second largest capsule shell manufacturer, my first level thinking was I want to own a part of it, right? And the idea is that this will grow. Thereafter, I said, no, so I was going to Delhi for some personal work, and the promoters are based in Delhi. So I said, I'll go and meet them. That was, again, a very good meeting. And my personal belief is, in investments, what I call people matter. If I look at some of my best investments, whether in the fund space or personal investments, not all businesses have to be sexy. It's the people who can make ordinary or average businesses good. So I had a very good meeting with the promoters who in fact insisted that first you go and see our plant and meet the management. So I drove down all the way to Alwar, saw the plant, met the management. Now the management did not seem to me to be a 40-50 crore market cap management. It was a good, reasonably good management who would do something more than this. So here was a company which was a 70-80 crore top line company available at a 40-50 crore market cap, profit making with a 40-year track record. And I think we tend to overlook longevity in businesses. Business cycles are coming down, newer innovations are happening. Somebody who survived for 40 years, we need to give them some, some weightage to that. And thereafter, I made a few phone calls to people, well-wishers, people I know, business contacts in Delhi, and I got very good references on the promoter. So I think all of this came together, and I ended up buying it. Having said that, I think Sunil Singhania's wife has bought into it after I bought into it. So that played its role. Gave the early impetus. I had bought the stock with a 3-4 year perspective, and my sense was that if it becomes a 4-5 bagger during that time, I'm more than happy. I think that the process is hastening right now, so no complaining on that. I think that's the thought process on Sunil.
That's an interesting process because I mean, if you look at, I mean, you would perhaps look at this as a balance sheet purchase. It could be a, I mean, however you look at it, I think the three things that stand out. One, you went and actually met promoters, or had an did a bit of scuttlebutt, if you may, the investment process being. I actually looked at it and I actually saw how these people were performing. Second was the soft factors, the management quality and the longevity, which, like you said, very few people give weightage for. And I guess the important thing here is conviction, that you'd say that the market cap is small enough for this company to grow substantially from here. So it's not like, it's not like something that will just that could just stay in that zone for a really long time.
Yeah. So just to add on to that, uh, I believe in something called as a margin of safety. At that price, at that value, I didn't think I had much to lose. My view was, even if the stock does not go anywhere, I am happy to own a part of this company for a long period of time. It's
That's
as simple as that. Uh, yeah.
Got it. So I think, yeah, this is great. I think this is an interesting set. And you've had actually not, I mean, this was a profitable company, but you also had a number of stories where, you saw the whiff of progress coming in, but these companies were deep into losses, and then they were just starting to turn around, or there was almost perhaps from a person who had invested in it earlier might be like, oh, there's no end in sight to this fall, and you've actually invested in some of them and taken them forward. To tell us some of the stories that kind of went your way and some which probably didn't.
Uh, so in the last couple of years, at least in the small and mid cap, there will be very few stories which have not gone your way. You might have something would have gone up 50% when something would have gone 300%, right? So to be very, very honest, barring one or two which are not turnaround stories, there's nothing else which has not gone my way. And I'm sure that is the case with most of us. If you are invested in the small cap, I will not even say mid cap space. If you are invested in the small cap space, and this typically happens when the industrial cycle is turning around. So if you look at 2002, there was enough and more money to be made in commodities and cyclicals. Companies were going through their worst, debt restructuring was happening. And I think those are brilliant opportunities, because you think about it this way. Let's look at, and I never discussed this company because I personally invested into it, but it's like Radha Madhav Corporation, right? It had a few hundred crores of debt, and I'm really bad when it comes to minute numbers. I always look at, I do the big paperwork. My investment decisions typically on the personal side happen within 15 minutes to half an hour. This was a company which is done in OTS, where the a few hundred crores to 70 crores, and there's an asset manufacturing facility sitting over there, right? Now, if you believe that the promoter, and I will not go into the fact that ethics of the promoter or whatever, but if you believe that the promoter is interested in market cap, and typically most promoters in India in a bull market are interested in market cap, you should start getting worried on small caps when you are in a bear market, because then the best of names will be available at throwaway prices. At JM, I had bought at a 7,000 crore market cap with a 700 crore cash sitting on it. Or in Ambika Cotton, I bought at 3P with a dividend yield which was very good. So in bear market, anyways, you will get those. So if you, in a bull market, you look at it saying that will these guys be interested in market cap? If they are, then they will show reasonably good performance on their books. With a debt restructuring happening, so he might be having a facility, manufacturing facility of around 400, 500 crore, with his debt now come down to 70 odd crores. Plus, there is a semblance of e-commerce or a multi-level marketing business with it, which is profit making. Then this could be an interesting story. Could this be a 10 bagger or a 20 bagger? I don't know. Could it be a 3 or a 4 bagger? Possibly could, and I am happy with those. I think the problem happens is when most of us are looking either on the private side as venture capitalists for unicorns, or as personal investors, we try to look for 10, 20, 50 baggers. Those happen, don't happen very often. But is it possible to get a fair shot at getting a 3, 4, 5 bagger? Yes, and that should be good enough, right? I mean, if you make a 3 or a 4 bagger in a 2-3 year period, I think that's fabulous with us.
Oh
So
yeah,
that's even Triveni glasses, which we discussed yesterday on the Slack, is a similar thing. If your debt is getting reduced and OTS is happening, and you're selling off your assets, so you'll be sitting with cash post that. Now, these are subject to everything falling into place, right? So today, when I look at the auditor's report for October, I see a 222 crore cash sitting on it, which the auditor has said that this is advance against sale of land. Now, I'm making an assumption that the final sale will also happen. And that's the call I'm willing to take. Because today at a 25 crore market cap, frankly, what can it do? 15 crores? 10 crores? I'm happy to sit with that. I'm happy to sit with that because there's an operating business with just a 10, 12 crore of quarterly top line with a crore of profitability. And I believe is now starting his second plan, which will double all of this in one time. Then you're willing to live with the balance sheet risks, assuming that the balance sheet is getting sorted out. But and at every cycle, when the cycle changes, you get some of these opportunities. More of them will play out, and few may not. But then that's probability. And as far as you get more than 50% of your investments right, I think we should be okay.
Yeah, that's well, 3, 4 baggers are great. I mean, if that's 300% return, if you're talking about that would offset a lot of your, 30, 40% losses that you might have to take if the stock doesn't move after, say, 4 or 5 years, because there's that margin of safety in the cash that they hold, and perhaps the fact that they still have an operating business. Like you said, it's profitable operating business plus cash. There is a debt component that is likely to go away because of the sale, and this kind of investing is very interesting because it's got that scope on the top side, but on the downside you have a cushion of something, and that something is either cash, operating business that has longevity, or simply the fact that the industrial cycle has changed.
Or the cushion is purely in terms of valuation. See, there are issues with the company, and that's where it's available at the valuation that it is, right? If everything was fine, then why would it be available at the valuation they are at?
True.
So I think that margin of safety comes from the price at which it is available. And as an equity investor, every asset is a good asset at the right price. Whether it's stocks, whether it's real estate, whether it's commodities, at a right price, every asset could be a good investment.
Very, very true, very true. In fact, I mean, some of the downside can be, and just to veer away, I know that we've not had any bad issues in the last couple of years, but you've been a longer term investor than this. So, what are the stories that perhaps you would call your biggest mistakes, and what could have you learned from them, or what would you change in those investments?
So, I started personal investment only after I left IDX. Before that, I never used to do that. I was managing funds. There were conflicts because on the listed side also I was investing in the fund. One big one on the fund was Tulip Telecom. Right? I have no idea, what went wrong over there. Obviously, the numbers were not true, and that itself is a learning. And I think when you are investing in India, you know that whatever you see is not what you get, or there will always be an element of you know, question mark around most companies. You know, we will not be taking names, but the best of names, uh, uh, there is nothing, not everything is clean about them. So I think you take it that with a pinch of salt. The saving grace was, it was barely 2% of my portfolio. So I had two bad investments in the first fund. Most of them were like 90-95% write-offs. But the learning from Tulip, at least the way I would take home, and I don't know whether I've completely learned that, but should have cut my losses. I just sat on it, right, and finally sold up 90-95% lower than the cost price. So that happens. Second, on the personal side, is an investment which I still hold. Is a company called Global Offshore. Right now, there's a there's a view I have. If you look at the shareholding of that company, the largest shareholder is a private equity fund over there. It's a Mauritius-based fund whose fund life has got over. The fund life has also got, if I'm not wrong, 2 extensions. Those are also over.
Wow.
Fund cannot hold beyond a point indefinitely. They are required to sell their investments, right? And they have not yet sold it. So I just tend to believe that maybe there could be a possibility of a strategic sale that can happen in this company. It's into oil field services, etc. I've been holding it for a long time, so it's almost 4 or 5 years. Not losing money on it, but yeah, opportunity cost wise, yes. So that's another one. Besides that, let me look. I think Touchwood, it's been an okay last couple of years. There are not, so that is there, and Radha Madhav is something which is still again at cost or below cost. But it's not that I've given up on it. I think it will pay out over the next year or two. Unfortunately, what happens is the markets, and especially the way the small caps have been moving currently, they make us impatient. So if something goes up in 2 months and 3 months, then you expect that yeah, something else has not gone up in 6 months or 9 months. Then you feel that it nahi chal raha hai. So I think you need to be patient to allow it to play out. Having at the same time being cognizant of the fact that keep watching it, because not all of them will play out. So,
I see.
You know, then you need to cut your losses in some where they don't play out.
I guess what you're also saying over here is there is perhaps a need to cut losses at some point, but also that you also have to give stock a room to grow. So it's going to be that a little bit of a battle that says which is that point, and whether that point is 50% below where you bought it, or whether it is a point where the business actually doesn't show signs of growing anymore, is a question that you'll probably have to leave to your own judgment at some point.
Yeah.
Cool. So I'll move on to the next part, which is, I think I know the answer to this, but I thought I'd ask you this. There is often a challenge of saying I want to own 100 stocks, or I want to concentrate my holding in a very few stocks. These are battles we've had on Twitter and on Slack and a number of things. What is your opinion, and is it better to concentrate holdings, and what number of stocks do you think you hold in general?
So so I'll answer the second question first. The number of stocks that I would have will be around 18 to 20, of which 5 odd will be 80% of the portfolio. And not that I've invested that much, that those have grown faster. Right? So again, a classic 80-20 plays. I think if you look at any of our portfolios, your portfolio, somebody else's portfolio, the Pareto principle comes into play, right? So that happens. What kind of a portfolio, and I firmly believe, is a function of what you are trying to do, right? If somebody is trying to preserve capital, somebody is very wealthy, comes from a wealthy family, if he's trying to preserve capital, then you don't need to be very aggressive. Your approach should be that was no, because some of them, if they just preserve their capital, 3 generations will be taken care of. So they don't have to go around looking for crazy investments or very aggressive bets. For somebody like me, we come from very, very modest backgrounds. So the way I look at it is that I need to create capital. And for that, you need to take aggressive bets. One. Uh, Second, I still feel today, suppose if markets tank, Russia bombs Turkey, everything goes for a toss. These stocks will halve, and even at half the price, there'll be no buyers for them, right? Uh, I feel that where today I am, at least I can go back to a job and earn back what I would lose in that scenario. 5, 7, 8 years down the line, that might not be possible. So this is my strategy today, saying that I'll be taking concentrated bets, aggressive bets. I personally prefer a concentrated portfolio because I think my attention span is not great. So I cannot monitor 25 companies, these companies, and stuff like that. And I believe it's investment decisions are binary. If you like something, then you can't say, no, I like it, but I only like it so much that I take 2% of the portfolio. I like it or I don't like it. If I like it and I believe in it, I will take a position as large as possible. Sometimes those large positions, at least when you're an individual investor and the salary has stopped coming, that gets stopped. That gets constrained by the liquidity you have. Right? So even when I was buying a SNI, I had a largest stake available, but I could only buy so much. Similarly, right now, I had to let go of a couple of opportunities. So personally, I believe what works for me is a concentrated and an aggressive portfolio. If all this works, or if most of this works, and I'm able to generate a reasonable amount of capital, maybe I'll change my strategy then. I'll say, no, now let me try and preserve what I have created rather than trying to, still double or quits kind of. To be today, it's like more of double or quits.
Got it. Interesting. I mean, I think there are two aspects to this. One you've said is that it's a function of where you are, creating capital versus preserving it. Also, to summarize, you also said you've got a cash flow. If the cash flow itself is constrained, in the sense there is no job or no income, then a strategy might actually be different than, say, when cash flow is coming in and you can allocate to a larger number of stocks perhaps. One of the things that you mentioned actually strikes home with me. I'm a concentrated investor almost by, but I can't handle too many, because at any time you're researching 30, 40 stocks. So you can't have another 30, 40 or 50 stocks sitting in a portfolio, because then that just jumble things up. But and importantly, like you said, if let's say you're able to grow to, say, 500 crores in terms of capital, 100 crores in terms of capital, investing 10% of that capital into one company, which may not have the liquidity to support that kind of investment, also will play a part. So you almost by definition, say an HDFC mutual fund which has 8,000 crores cannot be a concentrated portfolio, because it can't do 800 crores in one company. It might end up moving the stock so much it's not worthwhile to invest.
In fact, and that's where I believe that as individuals, we have a we are far better off compared to funds or institutions, because they can, a fund would never be able to invest in a CMI when I invested, right? It was an 80, 100 crore market cap company. Today at a 400, 500 crore, now you have to wait for everything to play off. Now you have to wait for performance to play off. Maybe a fund might be interested today, but at that price they wouldn't have. So I think as individual investors, we have a lot more, we have a larger spectrum of stocks available to us. And frankly, each of us need only 4 or 5 of them. And you need even 2 every year, and you will generate a substantial return on your entire capital. So we are far better off, and funds can typically not do these things.
Absolutely. I think I see where you are. You're screen, so that's just a messy thing. So actually this is interesting, because I mean, this is where individuals have a little bit of a structural advantage. They get a lot more companies under the 100 crore market cap levels that funds don't invest in. They also can, at the large cap level, do covered calls or a lot of those other strategies which funds can't do. So the individual is actually better off, but in a lot of ways, the Indian individual hasn't really taken advantage. And maybe this is the next era where the discovery of the small caps becomes the way to see next mid caps and large caps come along.
Agreed, but again I come back. It again depends on where you are in the life cycle of the market. I personally believe we are behind the bear market that we saw from 2010 to 13, 14, right? At such
Right.
point in time, these stocks nobody will touch also. In fact, you will get a better one at, so that's where I come back to an Ambika or an Apcotex, which are available at throwaway price. But today, if you believe that the bear market is over, in the next 2-3 years, we'll have interesting markets. I don't know whether it'll be a bull market or bear market, but it'll be interesting times. There is at least interest back in the markets. Then you could ride some of these opportunities. But
No,
then
agreed.
you need to be able to, you need to be able to get them off also. You need to be able to take your capital home when the time comes. Because when the market cycle turns, again, you end up otherwise holding some of these. See, what happens typically is, suppose if it's a pack of 100 small stocks, right? At the turn of the market, when the bull market starts, out of those 100, 90 might start rising. But when the market again turns back into the bear market, of those 90, 80 or 85 might have again start coming down. There'll be 3 or 4 or 5 of them which will pull themselves out of this and become a mid cap, or a mid cap which will become a large cap. Because they would have so much of momentum in their business and they would do a lot of the things right, which will take them into the next level. But you have to be aware that, I think most of us, we cannot have that ego that, no, what I own will be those 5 stocks which will move into the next level. You need to be aware that, this can happen, and have I taken back my capital or sold off these at the right time.
That's another way to it. I guess this is the point where you consider whether you want to sell a stock or not. One of the things that often gets missed in the value investing frameworks is, when do you sell? And perhaps in that context, let me go into my next question as well. What you've talked about some things that attract you for a company in terms of red flags and green flags. And perhaps a green flag of a company that pays dividend is that it actually has the cash to pay the dividend, which is because in the face of cooked books, at least the cash is not cooked to that extent, and perhaps prompt you to buy or sell investments.
Hello.
Hi,
Deepak, I lost
lost
you.
you?
Yeah.
Am I back?
Yes, I think so.
Sorry. So, I was saying, the one of the things that you had mentioned about a green flag for a company was that it would pay a dividend, and that meant that it actually had cash to pay dividends. What other red and green flags would you look at before you bought or sold a company?
Uh, it's, at least for me personally, I don't have a yardstick or a framework which says that only companies which will qualify into these things is where I will invest, at least personally. Uh, I don't know. It's very difficult to explain. There's sometimes you just we get a very good feeling about something, right? That could be after reading the balance sheet, and this our discussion on the taxation, I think, came from Capri Global. Capri Global has a history stuff around it. Can you hear me? Hello.
Can you hear me, Japan?
Yeah,
I
now
can
I
hear you
can.
clearly.
So I was not sure because your frame had frozen. So I was not sure whether I was audible.
I'm just making sure everything's fine. ठीक है, नहीं, should be good.
Yeah. So I think in different stocks, it's different things. Mm, One is the valuation which is available, whether if you meet the promoter, whether you got a good feeling about your meeting. And I frankly don't. It's very difficult for me to explain what, right? I met one chemical company right now. I forget the name, Sri something, the promoter, and I came back very happy after the meeting. So for nothing, it's not that we discussed a lot of business. We did not discuss a lot of numbers. I think on numbers, this company looks expensive, but you just come back very happy after the meeting. You just like the promoter, right? So I think that kind of works for me. For example, for Capri, I looked at it, and obviously there are question marks, or there's a history to it. But then if something is available at 0.5 book, an NBFC with a 1% net NPAs, uh, and he was paying taxes, right? So if the numbers are not right, then why would somebody want to pay tax? Or if he does not have the ambition to grow, then why would somebody pay tax? He'll take his money home, not pay any tax. So that's my thought process. And at least on NBFCs and banks, my view is, the next phase of growth right now, most of the banks are not in a position to fund growth. So that will come from non-levered or non-NPA hit NBFCs and smaller banks. At least in this phase of the growth, till the time these bigger banks are able to clean up their act, and I think it will take a long time because the Indian economy has grown. So if you look at a 2002 NPA cycle, we would be far larger today in terms of an NPA cycle than what was there in 2002. In 2002, it was manageable. This time it is slightly more difficult because the sheer scale of the economy has increased, and hence NPA as a percentage of the economic activity would have also increased. So I think that's where these smaller NBFCs or banks, smaller banks who are not levered or who are not hit by NPAs would be in a better position to grow their balance sheets.
So would this be like in this case, perhaps the JM Financials and the smaller Canfin Home, LIC finance kind of portfolios, or even smaller
Yes,
unknown names?
absolutely. So if you look at Ratnakar, Ratnakar has the ability to raise capital. It attracts good investors. So every time Ratnakar has gone to the private equity market, he's been able to get the best of names too. So in a financial, or at least in the lending business, the only thing that distinguishes one from the other is your ability to raise capital, and the ability to raise capital when you want it and when you get it, right. So if you're able to do that, then you're able to expand your balance sheet. So those kind of guys will be better positioned to take advantage of the next cycle of capex activity as and when it happens, or the individual borrowing activity, individual loans, etc. When that starts again going on. So a JM would be interesting, or for that matter, an Edelweiss also should be interesting. So these are all guys who manage their balance sheets fine, who are not so big that, and that's the other reason I like smaller companies and not only. Your base effect is not there, right? Because so small, you can grow at a 30, 40, 50% compounding for the next few years. For an ICICI or an SBI to grow their balance sheet at that rate, the risks they are taking will be first, those growth rates will not be possible. And if they make it possible, then the risks will be disproportionate. No? So that's true for financial services, that's true for any business.
Comparison. That's a great point. Actually, I mean, this may be one of the precursors to the next cycle. So if you're ending the commodity cycle and you're ending the IT cycle, you might be getting into another cycle of growth, which will get funded by companies that are less, banks and financial institutions that are less levered. So attack those companies today, and or at an appropriate point in this current cycle, and then you'll latch on to the next growth path.
If you want to take exposure in that space, that's a choice, right? Either you play the capex cycle or the business activity either through the balance sheet, the asset side or the liability side. So if you want to play it through the liability side, then you be with NBFCs and banks. If you want to be with the asset side, then go after smaller construction companies, EPC guys, smaller manufacturing companies, because again they don't have the baggage of the past cycle, and hence they'll be able to grow faster.
That's
And,
brilliant.
and
Actually, it's like
especially you will see this wonderfully well play out in construction. Every construction cycle, barring an L&T, will have a new leader. Because they will be in a position to expand their balance sheet, take the extra working capital loan or deploy their capital on new projects. Then they will. These businesses don't have differentiators, right? So then you will get into an excess period where you will say, I want order book to market cap. So you will take left, right, and center everything. Most of them who will do that will go down the drain. So the next cycle again, new guys will come up. So every cycle in construction, you will have new unlisted players coming up, or
brilliant.
nicer, cleaner, more listed guys who were sensible come up bigger and better in the new next cycle. So they might lose out in the previous cycle, they'll come out as leaders in the next cycle.
That's an interesting point. We've seen a few. I mean, seems to have much lower debt than, so it's got lesser baggage to deal with. Let's hope one of those becomes the leaders of the cycle going forward. But like you said, it could be an unlisted entity. GMR was unlisted until it listed eventually in 2006, and then of course it went to 1,000 before it came back to 20. But it still went to 1,000. So it's not a bad investment. And I guess to top it off, you've seen a lot of promoters, and I guess in a lot of ways people get shy away from public investments because they believe this promoter is a fraud and that promoter is just saying something and it's manipulating something. How important is promoter integrity to you? I mean, we say this, but I mean, I believe that most promoters have integrity issues and we still invest despite them. But to you, how important is that from a perspective of investment?
So I have a favorite saying, and I don't tire of it. I've been saying it for the last so many years. Uh, in a bull market, we analyze promoters with the saying, his ability to manage the environment is good, right?
Right.
In a bear market, you will change the words and you will say there are corporate governance issues. There is no difference between these two statements, right? Uh, in fact, in a good time, you will say कि यार हाँ project ला सकेगा ना, execute कर सकेगा ना, which is what in an Indian context, uh, what does that mean, right? So you need to be aware of these things. You need to be uh, keeping that at the back of your mind. It should be part of your decision making process, but you can't have a holier than thou attitude on that, right? uh, I mean, let's sit through the balance sheets of some of the best names, and we can raise question marks on a lot of them, right? uh, so I think, and I mean, I think when it comes to investments, I'm agnostic. uh, my view is, if the price is right, then I may overlook these issues. And again, I come back to the same saying that if I believe that he is interested in market cap, and if the environment is conducive for a market cap growth, then I will not mind participating in it, keeping at the back of my mind that there are been issues around the company, etc. Mm, Otherwise, no. This is again purely from a personal investing perspective. When I'm doing, or when I used to build fund portfolios, this used to be a big criteria for me, because there I have a fiduciary responsibility. I'm managing somebody else's money, right?
Right.
They are entrusting me with their money, we're paying fees for doing work and diligence which is better than what they could have done on their own. So then you will give a lot of lot of weightage, a lot more weightage to that, uh, and obviously capital first kind of an approach you will look at it.
I see. So in short, I think what's interesting here is you're saying there's a phase shift between you know, relying on completely honest, clean promoters to say that we cannot avoid a little bit at least of some kind of issues that will be make a promoter not exactly and completely honest, but at some level there has to be a personal judgment of whether, despite issues, keeping them in the back of your mind, you still have a substantial scope for growth in market cap, and the promoter is interested in that, because if the promoter wasn't, then he would be taking all the money into his own pocket in some way or the other. But if he's interested in growing market cap, then you will grow alongside.
Yeah, yeah.
Brilliant. So great. I mean, if I know that you've been investing, through a cycle which saw 2008, you saw a cycle where people refused to invest in anything, even if it was made of gold and they could see it. And you've seen now where even if they see a hint of yellow, they think it's gold and they run against it. You've A number of thought process must have changed over the years. What stands out as a significant change in your investing thought process, perhaps from the 2008 era to the 2015 era?
So what happens is, one, being a part of a larger institution, etc., you had the good fortune of having colleagues who are smarter than you. So you end up learning from all of them. You pick up. I think one big issue we have in the investment industry is there's a lot of ego, personal ego. Uh, Saying that मैं जो बोला, what I do or what I think is right. I think at least I've learned to pick up ideas from everywhere. I have learned to be flexible in my thought process. So, for example, when we were investing the first fund from 2009, it was an infra focused fund. It was doing a mix of private equity and listed. So on the private side, we used to own almost 4.5-5% of ATM. We invested 4.5% of VA Wabag. Uh, GR Infra Project, which is one of the listed companies, I believe it's a fabulous road construction company, amongst others. Then we were trying to create the listed portfolio. And our idea on the listed side also was that we will behave like a private equity. We'll take significant minority stakes and we'll hold on to it for years. But somewhere during our investment, we realized that the infra cycle is not turning around as expected. It's going from bad to worse. So we ended up changing, so I just saw Vasishta's.
I know, same here.
So what happened is we changed our tack. We said, no, we will not do this. The listed portfolio, we will create of companies where we believe are going to be segment leaders in infrastructure when the cycle turns. Now, when that's going to turn is not, I cannot predict, but I can at least identify companies which are good, which are leaders in their space, and which will be the first out of the line when the cycle turns. So then we ended up building a listed portfolio of Sangvi movers at around 80-90 bucks, Adani Ports at 130, IRB at 130, 140, Gateway Industry Parks again at 130. Because that is not very difficult to figure out. They were throwing out cash, or we knew that we could see that cash is going to be thrown out. Sangvi, with all its difficulty, was actually reducing cash in that cycle. His biggest client was on payments were getting stalled. So I think that flexibility, change in approach, and at the end of the day, what I've learned is that markets are supreme. You need to have that the lack of ego to say that I'll always be right. I think we will only be right when we actually exit that investment. Till that time, it's only mark to market, and it'll take one bad day for things to vanish, right? At the end of the day, you are still an investor, you are an outsider, you don't know what is happening in the company or an external environment. Something goes wrong in the economy, in the world economy, and we've seen it in the past. We've seen in 2002, 2008. Your wealth can vanish in a matter of days. So I think that humility has to be there. In that, if going is good. Thank God for that, and but be aware that something can go wrong in the future.
Yeah, I think that is the true sign of an investor when you always walk into investments thinking you know stuff. It is when you admit that there is much more that you don't know than that you know, or the humility in a way that you really become a student of the market. So, with that, I guess, sorry.
Yeah, always has to be that way. I think that's the key. It's always nice to say, me telling you that, हाँ ठीक है मेरे पास तो I have no bad investment. Where have you come and seen my Demat account? Me today saying that Sunil Healthcare rocking, 3 months it's become 2.5 times. Let me first sell and then say, okay, I made 2.5 or 3 times. I'm not sold off. So mark to market is just a feel good thing. Otherwise, besides that, it's nothing. Take money home, spend some of it, enjoy your riches that you create. I think that's when it's actually. And I think other
I,
thing to your question is, I have started believing a lot more in concentrated portfolios, at least for myself. When I invest money for my friends, uh, I don't build such a concentrated portfolio, but for myself I do. And for them, I see to it that if a stock doubles, they take the cost out and stuff like that. But in my case, I do it differently. We lost each other again, I think.
hey, Japan, sorry, I lost you
Ah,
there.
yeah. So I think that's it.
Hey, great. So that's a brilliant thing. And like Vashish said, we have to ask you right at the end, where do you see the Sensex in
You know,
2016?
I'm a perennial bull when it comes to India. So even at the cost of going horribly wrong, I think it should be significantly higher from where we are today. I think going into 2017, we will have some semblance of capex activity picking up. I think a lot of good work is happening on railways, uh, on roads, uh, and I think these two sectors will lead capex activity. It, they're not as big as some of the other sectors in office, so it will not be as rapid capex growth as what we would have seen in the past, because international headwinds will still be against us. I think we should be somewhere around 9,000 range
On the Nifty?
on the
That's
Nifty.
that's good. That's
But
20%.
to be really honest, I really don't care because I don't invest in large caps, right? So I don't care where the Nifty is.
In a way, you make your own Nifty, to borrow the words of Purinju, I
No,
guess.
no, but since you asked me, and we all have to get it wrong. So 9,000.
Well, there you go. It's Nifty 9,000. I mean, these are obviously not something we hold. But, on that note, thanks, Japan. This has been great. I wish you a very happy new year. And
Wish you
thanks
the
for spending
same.
the time here.
Thank you so much. Thanks.
And great. And thanks everyone for listening. We hope send comments, Slack, comment on this video. We will edit it and so on. So it's been a great year, and wish you a happy 2016 as well. Hope all your investments grow to way beyond Nifty's 9,000 level. Uh, great. Thanks so much. I'll stop the broadcast here.